Welcome to this exclusive workshop for senior citizens on planning your money life post-retirement. I now have the privilege to introduce our second speaker, Mr. Debashish Basu. He is the founder trustee of Moneylife Foundation and editor and publisher of Moneylife magazine. He's a chartered accountant by qualification with 29 years of experience as a journalist. Mr. Basu has worked with most of India's leading publications such as the Times of India, Business World, Financial Express, Business India, Business Today, and has written columns for Business Standard and the Economic Times.
Good afternoon, everybody. Thanks for coming. On a rainy day like this, the room is very packed, very heartening to see that. My section is about what to do when you're nearing retirement or once you retire. There's a few slides on what to do when you're a little younger, so that gives us a lead into what to do when you're retired. One of the retirement planning and what to do with your money before retirement and after retirement is one of the most difficult things in personal finance. And the reason why it's difficult is because there's so many things which one has to assume. You can never take for granted a variety of things, and that's why there are a lot of moving parts to it. The second reason is that for a younger person, it's much easier to make certain assumptions because everybody is more or less in a similar position at the start of the life. Everybody will need to buy an apartment, they'll probably get married, have kids. They're all exactly in the same curve in life, unless, of course, somebody has a handicapped child, which is a different story. But once you cross that period, everybody individually are all in different kind of situations. Our life paths are all different. We start maybe the same, but somewhere around the 50s, we end up all at different positions. That's why it's very, very difficult, and that's why everything is fairly individualistic. So I will provide some guidelines on how to go about and how to view different asset classes, how to view different kinds of financial products as you end up near retirement. I said there are many unknowns while planning for retirement. One of the first things is how much is enough and at what lifestyle level. Now, if you remember, I just mentioned that everybody's situation, everybody's position is different. So here is where the differences start cropping up. What is enough for me may not be enough for you, and vice versa. If we have lived in a certain kind of lifestyle, we may want to continue, we may not want to compromise. So again, there would be huge differences. At the time we retire, we have a certain expense profile. It'll differ from one person to another person. Whether we want to continue with that, whether we can cut down on anything, automatically a lot of things gets reduced. Like huge expenses today is in bringing up children, for instance, or you're paying your EMI for a property that you would have bought. So all of these things hopefully would be paid off, so expenses would come down. But everybody's expense levels are different. How much would the expenses rise? This is not an individual issue. There are differences, of course. Some people may need a certain kind of care, and for which he may have to pay a higher sum, but by and large we are all affected by inflation. And inflation is the single biggest thing for an individual to assess, and it's extremely difficult to assess because we are constantly fed by inflation numbers which are not correct, which the government of India tells us. I'll deal with that a little later. How much to save as you head towards retirement? I noticed that a lot of people, I've done a very interesting study. We took some 10-15 examples from a newspaper called ET Wealth. This is all about younger people. And every issue of ET Wealth, it's a weekly paper, there is a profile of a family and where their expenses are going and how much they have saved up. We notice a very interesting trend. They're all different parts of the country, different levels. Some are middle income, some are middle to high income. Somebody is from Andhra Pradesh, somebody is from West Bengal, somebody is from Karnataka, but all of them have exactly one same characteristic, which is more than 80% of their assets are in property. So they end up saving money through the route of property, directly or indirectly. They have, suppose they are earning 50,000 rupees, maybe 30,000 rupees is going into an EMI. So that is a saving. So there's not much else is left to save in any other kind of product which will take care of their retirement savings. So how much? Rule of thumb is, my sense is that we should save, if you want to pass on any message to your son, daughter, nephew, niece, any younger person, please tell him to save at least 25% of his income. If you do not save at least 25% income, and that too in the right kind of products, if you save 25% and put it in recurring deposit, even that is okay. But if you don't save 25%, then the choice of products, where you will invest and what will be the retirement corpus, is all irrelevant. The savings is first, that has to come. Where to invest is an issue, of course, and that's the majority of the questions that I'll be dealing with. Expected return from your portfolio. A person who is at 35 and saving, let's say, 30,000 rupees per month and putting it in a money back policy, for instance, and feel very safe and very happy that he's taking care of his retirement corpus, would end up with very little money compared to somebody who has, let's say, put money in a combination of a good quality mutual funds and bank fixed deposits. I'm not even getting into any other risky products. There's no question of going into a corporate deposit which gives you 12% or Unitech which gives you 15%. You don't even need to do any of that. Even if that person invests 40% in equity mutual funds and 60% in bank FD, a very simple, easy to implement 40 to 60 rule, you'll end up probably with 4 to 5 times more money than the first person who's putting his money in money back policies. So expected return on portfolio has to be calculated based on a certain average returns which history gives us a guide to. How long would the savings last? Very major issue. And unless the calculations are made at the time of retirement about how that retirement corpus is further going to grow, and how much you would be drawing down from that if you would be needing to draw down from that, you would not be able to calculate how many years that is going to last. There is a rule of thumb in the US. They are more advanced than us in all of these calculations, and they say that you should be withdrawing 4% from your retirement corpus and leave the rest of the money. So suppose you have 100 rupees and you draw 4% in first year, and then 96% continues to grow, maybe in a simple bank fixed deposit, and you would be able to, and you draw 4% every year, another 20-25 years you will be drawing down and the income would be growing and you would be fine. Variety of studies have proved that this is too simplistic. You cannot have such a simple rule as 4% and continue to do all right, because there are 3-4 moving parts in this. One of the biggest things in the US is there's hardly any inflation. Here the inflation is going to destroy your entire retirement corpus if you have kept it in a simple bank FD and earning interest which is taxable. So today every few years the government changes a little bit in the income tax rules so that some people are not forced to pay tax and so on. But the change that happens to this rule, regulation, is much slower and much more inadequate compared to the inflation level. So I'll explain this a little more, but roughly speaking, if you are earning post-tax interest, you will never be able to keep up with the high inflation that we are subjected to by successive governments. It's not a question of this government or that government. India is going to remain a high inflation country because of governance issues. It's nothing to do with you or me. Those are some of the unknowns. Then post-retirement, where to put the money? Obviously, I mentioned this earlier. What is the expected rate of return from this investment? Well, the first part was your building of your corpus, and the second part is where you put your money. How long will it last? How much and when to withdraw from principal, I've dwelt on this just now. When to withdraw from equity funds in case you are investing in equity funds. And I brought this in because ideally speaking, that is one way to fight against inflation. One of the ways that you can fight against inflation, you don't have too many options, by the way. If you list down your 10 options, you will have 8 of them will be invested in a fixed income product. There may be only 1 or 2 products which is not investing in a fixed income product. All fixed income products will leave you with very little money on a post-inflation and post-tax basis. So you really have very little option. So the option is to save in through equity mutual funds for the long term, and that's what we suggest. If we suggest that, we still have to deal with this issue. Assume you have a certain corpus, how do you draw it down? When do you sell? How to reduce that corpus so that you're not exposed to a huge decline in value? Based on all of these factors that you can't control, obviously you will have to look for something that we can. Among the other factors that you can't control is how long you're going to live, and that is really the distinction between the accumulation phase and the post-retirement, that is a withdrawal phase. When you're accumulating your corpus, I cannot emphasize this enough, when you're accumulating the accumulation phase, there are 2 things that are happening. You're putting small amounts of money, and you're putting it for a very long period of time. You can see, there's visibility, unless something happens to you, which we don't, obviously, for which there is insurance, but that is separate. In a normal situation, we can see that we're going to save for another 30-40 years, let's say, or at least 30 years. We can see that this is the money we're going to save. And we can also see, based on historical returns, we can calculate if we save so much in these kind of products, this is going to be my corpus, let's say around at 60. After that, once we have that corpus, all the uncertainty starts. The corpus has to last for as long as you live. That's one of the most important things. I mean, I'm sure you'll all have enough money to last for as long as you live. But you would be surprised to know that when you start making certain cold calculations, a lot of people will find these calculations quite frightening given the level of inflation that we are subjected to. And for some of them, money may not last if they were to do all of this independently of their own account. The money will certainly last in some way or the other. In what way? I'll explain that later, because we all get support. We get support from our children, and so if there are larger expenses, somebody or the other pays for it. But my whole presentation is on the assumption that it's your money and you want to live independently, and whether that's going to last or not. So that is an assumption over here. We can't control irregular expenses, and also what other financial or non-financial support we would have, as I just mentioned. What you can control is how much you save and invest post-retirement income, which comes out of where you invest, and regular post-retirement spending, and investing in assets which does not lead to heavy taxation on the income that you can make. As I mentioned, just a few slides on the run-up to retirement or the pre-retirement phase, may or may not be applicable to you, but I sincerely believe that this has to be shared with a lot more people. So please, by all means, take notes. And I just mention these points to somebody younger, because they also would be in a situation that you and I are as of today. And this is very, very important for people to understand what it's all about. I've just mentioned that the younger generation today is forced to, not out of some of it is their choice, but some of it is not their choice. They're forced to save willy-nilly in property. The typical income expenditure flow of a younger person is like this. The money is coming into the bank, everything is paid by check. So you're typically getting a salary, or you're probably getting a professional income which is coming into the bank. Most of us, me included, are very lazy people. So the money lies in the bank, doesn't go anywhere. After a while we wake up and say, hey, so much of money lying in savings account, what do? alertness only takes us to the only very next easy step, which is to go to the bank and say that, no, why savings account, let's put it in an FD. That is our level of activity. Now if we don't consciously plan to invest, typically what happens is that the money comes into the bank and it's only surplus that is going into savings bank account and FD. Remember, in an automated manner, or maybe you're writing checks, the money has to go to also a housing finance company to pay for your EMI, which means that a lot of people, a lot of today's generation will end up at a retired stage with huge amount of money in the one and probably the property they live in. Many people are also moving from a 2-bedroom to a 3-bedroom because it pays for itself. You go into a property, it goes up in value, you encash it, you go add a little bit more, you go into a 3-bedroom property. So what happens is that at the time of your retirement, you have lots of money in property, but you don't have cash, and you don't have encashable security, as it's called. You don't have any liquid assets, you don't have mutual funds, you don't have debt funds, there's probably not much money in bank FD either. So the least one should do in this entire process, even if you're absolutely lazy about this, and please convey this to whoever you meet, please avoid the wrong products. Save as much as possible. I said minimum 25%, probably more, and start the whole process as early as possible. It makes an enormous difference if you start early and you save in the right products and don't make the mistakes in saving in products that lose money, and rather choose to save through products which create wealth. Only these 3 things that you are able to convey, it will be of great value. I mentioned that based on historical returns, we can calculate how much money a certain investment will grow to. This applies equally before retirement and after retirement, but because it's the same set of products, yet you are analyzing. My assessment, no matter what anybody says, there is a lot of numbers which people throw at you. When the market goes up, some people say that you can invest in shares, it will grow at 20% per annum and so on. Some people will give you the example of Sensex, which has grown from 1,000 to 19,000 and so on. All that's not correct. According to me, in a normalized way, given the ups and downs of the economy, you can possibly expect to get about 11 to 12% if you invest in equity mutual funds gradually over the long period of time. If you invest in bank FDs and it's taxed, that's the kind of return that you would probably get. Corporate bonds get you only about 1 to 1.5% more. If you invest in unit-linked insurance plan, it's more likely to be 6 to 7% post-tax. If you invest in traditional insurance products, which is a money back or a whole life policy, or one of those traditional insurance products which LIC used to sell and they continue to sell, your returns will be in the region of about 4 to 7%, not more than that. If you invest in the traditional products of private insurance companies, it's going to be even less. So I just mentioned LIC. If you ever want to buy money back or one of these things, don't buy from HDFC Life or ICICI Prudential Life or whatever. At least buy from LIC. The other retirement products, as it were, which is public provident fund, new pension scheme, or any other such schemes, is going to fetch you about 8 to 10%. Gold. Many people save in gold. It's not going to be very, very spectacular kind of a return. You will have to pay 10% gains or 20% with indexation. So after post-tax return is going to be about 6 to 9%. Most people save in gold for a social reason, and that kind of reason is perfectly valid. It's not about the money, it's about a certain thing that you want to pass on. So I leave this out as an investment product. Pure investment products are equity mutual funds, bank FDs, and traditional, these other ones. Now, as you would notice, that 12% is post-tax because long-term capital gains are tax-free. So the difference between a bank FD and an equity mutual fund, 2 caveats. Good quality equity mutual funds held for the long term. Long term is not less than 10 years. So if you do that, then the return from equity mutual fund is more than double that of bank FD. And it usually does not matter when you invest. even if you were to invest at a peak market prices, let's say even if you were to invest when the market is peak and you held on for more than 10 to 12 years, you'd still be getting a return not too dissimilar from this. It may not be 12%, but you'll still be getting a 10% post-tax return, right? So the differences are huge. Now, this applies to everybody. It applies to pre-retirement, post-retirement. These are the what are called the base returns. These are the returns that we should be starting to work with. In any calculation of how much will my savings grow to, please apply this for the long term. It's not about short term at all. In any case, you can't invest in insurance for the short term. You don't keep your bank FD, you don't liquidate, do something, go back there. Willy-nilly, even your bank FD is a long-term investment because it keeps growing and you keep compounding. Gold also is a long-term investment for all of us. ULIPs are by force. It's only when it comes to equities or shares or equity mutual funds that we start getting a little fidgety over the short term. I guess the answer to that is forcing yourself to look at the long term. Too many products in the marketplace are wrong. Wrong as in they will lead to either very low returns or will give you such frustration over 5 years also or 7 years also that you will wonder whether I've done the right thing or not, and you may just out of sheer frustration take your money back after a lot of charges and after suffering a loss. Unfortunately, today the most profitable, or rather the most well-funded companies are the insurance companies. So they do a lot of promotion or advertising, and Sucheta would have mentioned some of the celebrities that they bring in to advertise their products. The whole purpose is to get you to invest for the long term, giving you an idea that this is all very safe and you will get a lot of money in the end. This is a complete blatant lie. I can explain this to you with a pure number why it is such a lie. In life, you can either choose safety or you can choose growth. You can't have both. So if the image is of that you're very secure and you're very safe over 15 years, 20 years or whatever, the company to live up to that promise necessarily have to invest in safe and secure products. And safe and secure products are fixed income products. They are debt products. They'll never grow. They may grow a little bit when interest rate is going down. They move in an inverse proportion. But what effectively an HDFC Standard Life in this case, but they're all the same. I have no love lost for either of these. All of these long-term products, what they do is they'll take money from you and they will invest in, let's say, 8.1% Government of India bond. Something that you can buy also. So that 8% income is what they're getting. That is the income. It can, if they buy 8.1% bond held to maturity, that is the income. It can never be 9%. It can never be 20%. All right, unless of course this interest rates go down to 2% and the bond values go up. But typically, this is the coupon and this is the maturity value. That's why it is safe. Similarly, 8% is not going to be suddenly become 6%. That is a safety aspect. So that is the income that the fund is making for you. And then comes the charges. So you have to pay for this advertisement. And you have to pay for the commission of the guy who sold it to you. And then the overheads and salaries of HDFC Standard Life, etc. Those are the costs that you pay. But ultimately, where is the money coming from? It's coming from the same corpus. They're not putting money from their pocket, right? So if 8% is the income or 8.5% is the income, and if the charges are 2%, you're left with 6.5%. That's all you're going to get. There is no scope for 8 to become 12 or 13 or 15 or whatever. It doesn't grow like a stock. Yes, please.
Does not the treasury function allow them to make more money?
I don't know how to share this with you, but I have looked at every single kind of trading operation, whether it's stocks or bonds, whether it's the big traders, small traders. Yeah, I'm explaining this to you. Anybody who tells you that I buy and sell and make money, either he's a genius or he's a liar.
True.
It is extraordinarily difficult to do. There are people who with 15 years, 20 years track record as hedge funds, they've gone bust suddenly one day. It's not a question. These are proven people. There was a natural gas, there's a fund which was investing in commodities called Amaranth Advisors. It had $6 billion. Can you imagine the money?
But
that fund.
Part of it is because of greed.
No.
But there is a scientific function also. The commodities market is there, derivatives are there.
There are two aspects to it. One is that those who do this for a living, for a profit of whatever, an independent class of people, they, as they say, they live and die by the sword. If they can't make money, they go bust, then they will not get the money. That's a different class altogether. What is worse is those, pardon my words, but those who are on a salary, because they, on the other hand, have no incentive. If the fund doesn't do well, let's say JM Mutual Fund, NAV of a particular scheme from 10 rupees has become 4 rupees. Has anything happened to anybody there? Nothing has happened to anybody. The guy who will leave this job will take another salaried job somewhere. He'll become a fund manager in another place. He'll become a portfolio manager in another place. Exactly. That is what has happened. He's left JM, that fellow Sandeep Savarwal, he went somewhere and then he's joined now Prabhudas Leela as a portfolio manager. They've hired him, right, to manage money. So this buying and selling business, it needs extraordinary skill. It needs years, it needs decades of experience. It needs incredible skills of managing your positions, and it's a science, an art by itself. There are books there's a book by a chap called, I'm sharing all this with you because I've got deep into it, what happens, what people do, their behavioral biases. There is a author called Ralph Vince. He's written 4 books on how much to bet, as they call it, the position size. And those 4 books are full of mathematical formula. It has reached that level. You think any of these people, you think HDFC Life's fund manager has even heard of Ralph Vince?
These treasury managers have fantastic salaries.
That's what
they've got responsibility.
Exactly. As long as we put our money in this, and as long as the one HDFC product, and we wrote a cover story on these traditional plans, would give you how much, 2%. We had done an actual cover story. The title of that cover was just 2% from your life insurance, ? And there's no letter, nothing come back. Nobody from HDFC Life has told us that your calculations are wrong. So it's all out of our pocket, essentially.
Another product which these banks are marketing, that they take the money and they say we'll invest overseas because there are 2 lakh remittance in that scheme. How safe or good is that?
Absolutely unsafe. Zero. See, there is a principle which a lot of people are now starting to accept, which is, it's an American word, and it says that what is your skin in the game? Meaning, are you playing it yourself? Are you going to get hurt? Are you playing it? Is your skin going to get scratched if something goes wrong? So skin in the game is the term that a lot of intelligent people are asking. What is your skin in the game? Nothing.
Your own money or someone else's money?
Exactly.
Mutual fund has a same story of this, I think. It is similar like this.
See the difference between a mutual fund and an insurance product or a debt scheme is very, very fundamental. There is at least a scope. Because of the underlying shares that you buy, you may not be a very skilled person, but if you bought 30 blue chip stocks and held them for 25 years, okay, and you not bought and sold or whatever, it's not your skill. You have chosen the right kind of stocks at one time and you've been patient, sufficiently long term in view. You can't go wrong. But there is not even a scope of that over here. This products is not going to grow. ITC has become gone up 4,000 times in 20 years. But a bond is never going to grow that like that. It's just not, it's not technically not possible. There is no scope for that kind of a growth.
But in mutual fund, who are regulating those mutual funds, who are not proper and they are not...
I said two things.
That is worse
The right mutual funds, there are many, and held for at least 10 years. So either the fund companies should not make the mistake, or you should not make the mistake. If either of you make a mistake, then it's not going to work.
What would be the return on mutual fund if you hold it for 10 years?
That's just what I mentioned, right? That's it.
12%. So 10 years I hold it, I'll get about 12%. That is a
10 to 12% post-tax, because it is tax-free. Moment it's more than 1 year, it's tax-free.
How do you choose the mutual fund?
That's a separate session. But fortunately, it's not very difficult. We do mention it in the magazine. We have a table which gives every month. It's every alternate issue. We are a fortnightly magazine, so every alternate month we publish a table, which are the 3 best and 3 worst under all different categories. If you ask anybody, give me some names of good mutual funds, they'll all tell you the similar names. If he's not a crook, he's going to tell you all similar names. He'll tell you HDFC Top 200 or HDFC Equity or Franklin Templeton Prima. These are the names which everybody has. It's not something I've discovered. It's not a stock that I've, discovered and I'm sharing with you something that will grow 10 times. These are the names that will come up in any reasonably analyzed list. So if you go to Value Research online, they have a thing. So you look at 5 years, which are the ones which have performed all right. It will be the similar kinds of names. Every quarter you will get the same kind of names. Out of 300 odd names, there will be 30 names which will keep changing the ranking. There will be, 5th one will become 7th in one quarter, it will become 9th in another, or 1st in another. It's within that. Fortunately, the international and Indian studies have also proved that while the top quartile members, change a little bit here and there, the bottom quartile members never change. Which means those who are bad it's very easy to eliminate the ones that are bad. Yeah, exactly.
At a seminar I attended, they mentioned that you should find out who portfolio managers before you choose the mutual fund.
So portfolio, these are all small companies. Essentially, mutual fund looks very big, but they're very small companies. Okay, so they'll have one key guy. Let's say in ICICI there is a chap called Shankar Naren. In HDFC there is Prashant Jain. In DSP BlackRock there is Nagnath. So there may be a particular fund which is being run by somebody, but Nagnath knows exactly what is happening inside the fund, what is he buying, and in any case they are pretty relaxed people. They're not supposed to day trade, buy and sell every day, and once in a while they'll have to sort of review the portfolio and buy. So it's a very small team led by one person. It's very easy to identify, and fortunately these people, unlike the others where I mentioned that they leave the job and go away, all of these people have continued for a very long time. Nagnath has joined DSP I think in the 90s, and he's continued for last 15-20 years or so. Prashant Jain came from another fund which got merged with HDFC in 2001. So he's there for about 12 years or so. So, yeah, Balasubramanian has also been there.
Sir, I had an investment in PMS in angel fund. Since last 4 years, I had invested 5,20,000, and as on today it is 4,61,000.
Yeah.
So can you help me that whether how they are charging, because they goes on charging like maintenance fee and brokerage even.
This is exactly why I mentioned,
And then how to, because day to day we don't understand market strategy, so that's why it is advisable those who are expert, we give them, and this is my worst experience.
We have done, unfortunately, portfolio management. This data that I looked at, for instance, this is historical data based on similar products over several years. So you can analyze this data. Unfortunately, the ULIPs, we had to make an assumption because ULIPs data is not available, and they kept on changing the nature of the product. Because in 2010, ULIPs were changed. Before that, they were different, and in 2006, they were different. 2001, old ULIPs, they were different. So you're comparing oranges and apples. For PMS, there is no data. We have actually filed an RTI with the SEBI saying that this is in the interest of the customers. Nobody can make up their mind unless you can make an analysis like this. So if you ask me, I can tell you there are 230 portfolio management companies in India. So if we have the data, over 5 years, 7 years, 8 years, I'll be able to offer you one number. Of these 230 companies, we have analyzed them. The average return is, let's say, 2% or 5%, including all the losses. And unfortunately, I'm not able to offer that number, historical number. Whereas we have a lot of stories. I have not ever come across one satisfied customer of portfolio management services business. Not one. There is a gentleman, by a stroke of luck, he invested sometime in 2004, 2003, I think. It was a 5-year PMS. So by a stroke of luck, he got out at the peak of the market, and then he's kept his money in FD after he talked to me. Because to go back over there, he would have lost another 40% of it. So it is a matter of luck, all right? It's not a matter of skill. The reason is very simple. These businesses are all designed to take, there are asset gathering businesses. If they have 100 crore, they're able to charge you, 3%, 5% of that and make 5 crore. That is the income, that is the goal. The goal is not to make your 5 lakhs into 10 lakhs. That is certainly not the objective, and as I said, it needs tremendous amount of skill to do this on a short-term basis. Most people lose money. To do it, they could still do it on a long-term basis. I mean, I don't know why they don't do it, because they do not have obviously a vision to create a long-term business. So while they do the buying and selling in the brokerage part of the business, for the PMS they can still certainly buy good quality stocks and hold for the long term, but they don't even have the skill. There was a lady here who had come, an ophthalmologist. She's a doctor who retired from KEM and put her money with JM portfolio management scheme. Some 45 lakhs of hers became 26 lakhs. She specifically told them that I don't want you to churn. I don't know much about it, but I know for sure that I don't want you to churn. And these are my blue chip stocks. You decide, but I think these are good stocks, you should be holding them. They sold all the stocks, they bought something else, they bought and sold, and this was the result. So this is a story, and if you go to search by portfolio management services in our website in mutual funds, we have written a lot about these. And then we got so horrified by these stories of the savers that we told SEBI that this data has to be on the website so that the people can compare. Because without comparing, how will you, somebody would have referred you to Angel. Wouldn't have been much better for you to, for somebody to show you that these are the 5 things I've compared, this how they have historically performed, and then make you choose. But you cannot make that comparison today because the data is not available. So we fought, then they refused, then we filed an appeal. In an appeal we won. So now SEBI is at least putting out a little bit of data, but that is also not enough, not adequate.
Sir, how do you decide whether you got to invest or trust somebody else to invest?
No, I don't think you should trust anybody. These are, as I said, the game is very simple. Save as much as possible. Put it in some of these good quality mutual funds, and don't look every day. And look at it only over the long term. Anybody can do it.
Do you have similar working for debt equity funds? I mean, do you have like equity fund?
Yeah, we have done an analysis. Debt funds we've just completed the analysis. The next issue we are writing about it. For if you are in the 10% tax bracket, that's a low tax bracket, 10% or below, let's say, FD every year, every 3 year, every 5 year basis, bank FD is better than debt funds. 80% of the time bank FD will give you more returns than debt fund on a post-tax basis. If you are in a 20% tax bracket, 60% of the time a bank FD will give you a better return than debt mutual funds. If you are in the 30% tax bracket, almost 70% of the time debt mutual funds will give you on a post-tax basis a little better return than bank FD, because FD is fully taxed and you got a tax concession there. But there are two major problems. One is that there is a variability of return, which means in some one year it may be 2%, another year it may be 9%. So the way finance professionals calculate is that they take into account this volatility. So you're comparing FD, which is not volatile at all, which is fixed. Nothing is going to happen to that capital. The capital doesn't go up and down. Interest is fixed, it's guaranteed, literally guaranteed, because even when Global Trust Bank went bust, nothing happened to the fixed deposit holders. No, it's in the Indian context, the RBI will not allow any scheduled bank to go bust and people lose money. So in that sense, it's guaranteed, whatever the law may be. So you are comparing one class of product where capital is guaranteed and interest is guaranteed, which is taxed, with another kind of product where it goes up and down. It's volatile. Like now, last 2 days, last week, because of the RBI policies, you saw how debt funds have crashed. So way to analyze these two different things is to calculate for this what is called a volatility adjusted return. If you adjust for the volatility, for the safety of the principal and the peace of mind with this, even for the 30% tax bracket, this is better. Okay. Another point is that this return is an average return of what we have calculated it, at least a bond schemes with 100 crore of assets. There are ones which are smaller also. This is an average return. You can calculate only average. You can't compare each one of them separately. Whereas here the interest rates are more or less the same across all banks. If for any reason you've chosen not such a good fund, for what variety of reasons, because choice is involved here. Here there is no choice. Your corporation bank is as good as your Canara Bank. Okay, so you take that into account also. Here, if you for some reason chose a product which is not as good, then your returns are going to be significantly lower than that of bank FD, volatility adjusted. So our principle after doing this research for so many years is that we don't have to worry about debt funds. There are so many of them. Pick and choose, buy, sell, there's no need. For your fixed income, in fact, I've jumped because of your question, a lot of things that I would have said later, I've said just now. For your fixed income part of your portfolio, an average person must not look at anything other than bank FD. It's an absolute relief that we came up with this conclusion for the average saver. It's only for the growth part that you need to look at the mutual fund companies at all.
Amongst equity mutual funds, there are three variants. One is growth, dividend payout, and dividend reinvestment.
Growth is the best option.
Growth is the best option.
Okay, how much money we need? Obviously, this is all very individual. You have to define. Basic is obviously money for food, basic expenses, comfortable, a little bit of traveling, visiting family, pursuing hobbies, etc. And if you want a luxurious lifestyle, multiple homes, extensive travel, fine dining, these things. This is all very individual, but these all will influence how much of money you need and how much you will draw down at what rate. As I said, in question answer session seemed to have started before the end of the presentation. So I've already mentioned this. You need high returns. You need higher returns definitely, because you need to beat inflation. So you need to take a little bit of risk. If you prefer safety, your returns are going to be low. We need to find a way to mix these two. And I mentioned that somebody who started investing now or even after post-retirement, you need to mix the two. Put some money in safe products and some money in the in high growth products. I've mentions some guidelines of people who are between 21 and 35 age group. This is the way, this is the way they need to mix their products. If they are saving, let's say, 20,000 rupees per month, 15 to 20% of that should be in a recurring deposit scheme or a bank FD, and the rest of the money should be in equity mutual funds. The differences of not following this or following this between these two scenarios are enormous. Here is an example of 10,000 per month, which is growing at 10% per annum. Why I say 10%? Because I mentioned 10 to 12%. Somebody asked me what is the base return we can expect. It's about 10-11% in equity mutual funds, post-tax basis, and then you mix it with 15-20%, which will be taxable. So you combine the two, which is roughly 10% per annum. Even 10,000 per month invested over 30 years will grow to a huge corpus of 14 crore. It's not a small sum. If you start a little less, obviously you have a little more of liabilities and responsibilities, so your mix has to be accordingly adjusted. You put 25 to 30% of your money in fixed income and the rest in equity mutual funds. It's still a long way off, another 20 years or so of savings that you can do. As you can see, because this person would have started later, even at 25,000, which is 2.5 times of savings, the money that gets accumulated over 30 years is much less. It's literally like 1/3 of the first person. This is where the power of compounding comes in. Somebody who is in the age group of 46 to 60 will have to further tweak the asset mix to be a little more safer. So their fixed income is about 30 to 40%, and equity mutual funds is about 70 to 60%. If they start at that stage at 40,000 per month, see, the amount of money that's needed to be invested is constantly going up to reach probably a smaller number, because you have so few years to then go. So this is all about pre-retirement. If you want to share this with somebody younger, please do that. This is the path until you retire. Just after retirement, these are the questions. Where to put your corpus? What is the return to be expected from the corpus, and how long will the savings last? When and how much to withdraw from the principal? When to withdraw from equity mutual funds, which is a very important decision to take if you have taken that route, and whether there is any post-retirement income and support. This is a very significant amount in financial terms, the last point. It's just invaluable. If you were to sort of put a monetary figure to it, it's very huge. After you retire, these are the options typically that are that people normally consider, which are very safe options, which is immediate annuity. Annuities are what? You give your corpus to the insurance company. They take the money, they calculate how much are you going to live. They have longevity tables by which they calculate that, and they offer you a fixed amount of money every month till you live. It's a very comforting kind of transaction, because no matter how long you live, the money is going to come to you. Unfortunately, that money is taxed. So if you give a corpus of, let's say, 1 crore of rupees to a life insurance company, and suppose you get, let's say, about 5% or 6% in terms of annuity, you make about 6 lakhs a year, and that 6 lakhs is taxed. So post 6 lakhs, suppose it's 10 lakhs, which is fully in the taxable bracket, you're going to end up earning about 3 to 7%, which is what I mentioned over here, which is not such a great deal if you really compare it with putting in a safe.
That even the insurance companies have to pay service tax on that. Am I correct?
Insurance company.
On the annuity which they give, have the insurance company also to pay service tax?
Possible.
Because I saw one scheme of State Bank of India. She was trying to convince me. I went to the small print. I found that they have to pay service tax. I asked her, when you are earning, if you are going to pay 12% out of that, that means my return are least to the extent of
absolutely
relatively little.
That is true.
But that was a shock for me, sir.
Thanks for enlightening us. We'll definitely use this at some stage. Thank you. Then there is Senior Citizen Savings Scheme. You can invest up to 15 lakhs. It pays about 9% per annum quarterly. Maturity period of 5 years, can be extended for another 3 years. This is a 9% fixed, but right now we are probably getting into a situation where interest rates are again going to go up, and they're going to go beyond 9% for quite a while. A lot of people are expecting interest rates are not going to remain high after this RBI's decision, but I am not so sure, because we do not have the economic fundamentals in place for interest rates to come down. So if you do that, you've locked up your money in a 9%, whereas any other bank would also be offering you 9%. In any case, 8.75% is something, plus certain concession for senior citizens is anyway you're getting for a 3-year bank FD. So this doesn't make any sense at all.
Now this is taxable. Earlier it was not.
Yeah. No, it was taxable. TDS was the issue. It was. No, it was taxable. TDS was the issue. There was, then there is something called monthly income plan, which mutual funds companies try to sell you. The part of the money is invested in equities, and a small part is invested in equities. The bulk of the money is invested in a fixed income. This really doesn't make any sense. First of all, the name of the scheme itself is a misnomer. They don't give you any monthly income. Okay, the value of that, the NAV of the scheme may go up. In certain cases, when the equity market is not doing well, as has been this case for the last 4-5 years, your 15% part of the money is not going to earn anything unless it's invested in high quality stocks which go up. And I have mentioned that it's not easy for fund managers to do all that. It only can be done with hindsight, not with foresight. The other 85% would be invested in a debt scheme, debt products. And as I mentioned, in case of insurance products or debt mutual funds, there is no fundamental difference between the income that you get out of your bank FD and what the mutual fund gets or the insurance company gets from their debt investments. There's no major difference, almost the same. And plus you have to pay taxes on that. It's not tax free. So finally, none of these are great choices. They're okay up to a point. Third one certainly is not a good choice at all. Senior citizen savings schemes, anyway, the interest rate is not all that attractive, and as I mentioned, annuities are taxed like anything else. Now, I mentioned several times in the past that earlier in the presentation that the most important thing to calculate is how inflation going to affect us. These calculations are not easily available. I don't know why people should put out on a regular basis. The inflation that affects us is completely different from the inflation figures that Government of India announces. First of all these days you had what is called a wholesale price inflation, and you had a consumer price inflation index. The consumer price index was based on the consumption pattern and expenditure pattern of industrial workers. All right, the prices that we pay as urban people are on a completely different set of basket of products and services. Bulk of our expenses are really services. In the composition of a senior who's living in Bombay, he'd be paying a lot of money on various kinds of services, whether it's a maid or whether it's assistants, or whether it's a car cleaner or a variety of the carpenter, all of these things. The services inflation is not calculated separately. And my guess is that the net impact of all of this, including oil prices and transport and all of that, is not less than 11 to 12% per annum. That is my understanding of inflation that affects the urban people of India. It's not 4%, it's not 5%, it's not 7%. Now, I have an interesting chart for you. Suppose you retire, let's say 15 years from now, and your monthly expense is about 60,000 rupees a month, all right? And you retire with a corpus of, let's say, 1.66 crore. This is based on my largest seminar that I do on retirement. I have just taken a slide from there. And you put this money in a bank FD, which earns you, let's say, 9%. You take for the sake of simplicity that you are not in the tax bracket, although you would be at 9%, you would be at 1.66 crore at 9% interest, you would be in the tax bracket, but just assume it is not. Your expenses, even at 9% per annum, starting with 60,000 per month, is going to reach up to 4.8 lakhs per month 25 years from now. This is a simple arithmetic. I have not added anything here. I have just taken 60,000 and I have compounded that figure at 9% to 4.8 lakhs. I am mentioning orally 11%. I am mentioning orally double-digit inflation, which affects us. So in that case, it will be much more. But just assume it's at 9% only. If you put the money in bank FD and you earn that income, by the time you are in the 19th year, by the time you are somewhere in your 7th or the 8th year, you see that purple line going down, which means you have started drawing from your corpus after 7 or 8 years because your expenses are going up. All right, your income is coming down because you started drawing from your corpus. Somewhere in the 19th year, you have drawn down fully your corpus. So this is the way rising expenses, investment in a product that doesn't grow, and a continuous drawdown over a long term affects our savings. Now, there's nothing to get scared about. There are assumptions here. The assumptions may not be valid for you. You could very well say that I don't need any of this. I live with my son. He takes care of me. So then I shut down the chart and it doesn't matter. All right. And finally, it's overly simplistic. You may start with maybe 50 crore. For all you know, you may have sold you have 2 properties, one you sold, so it doesn't affect you. But just to give you an illustration that the calculations that we make do not take into account this kind of dramatically rising expenses. And while the number of 1 crore, 2 crore seems very large, over a long period of time, thanks to this relentless increase in costs, it can really create a problem 10, 15, 13 years from now, as has happened in this case. Right. These 9% is something that affects all of us. So this is a fixed. Your argument could be that we are reaching a golden age of growth. So our growth is inflation is going to collapse to 3-4%. That is an assumption you can make. I don't make that assumption because there's so many infirmities in the economy. The way decisions are made, the way the resources are allocated, there is no chance in hell that we are going to have a low inflation economy as long as politics dominates decision making. This is the reality. This is the absolute reality across the country. In fact, the poor are affected even more on a relative basis. At least you're starting here with this kind of a figure. The way the poor get affected because they have no means of increasing their income. They may have invested in a chit fund. So instead of 9% growth, the money would have gone in 3 years. They have no means of investing in the right kind of products or the right knowledge.
Excuse me. What is the reason that there is a lot of difference in the inflation rate at developed countries and in India? What can be the basic reason?
The reason is efficiency.
Efficiency
of the economy.
Okay, so that means we are losing a lot of money in terms of bribes and wastages and.
No, we are losing. In India, the government sector is very dominant.
Okay.
It's a very large segment of the economy, and that is a very wasteful segment of the economy.
Okay. So the productivity is low.
In the US, the government sector is not that dominant, and it's a very efficient part of the economy. The resources are allocated correctly. It's a merit-based economy.
Okay.
The good guys come up on top generally, not always, but generally. Sorry? Coal India is a great example of wastage. Or ONGC, fantastic example of the Reliance's deep sea wells. Such a huge facility they have in KG Basin has a staff strength of 50 people over there in the sea. And ONGC, with a much smaller size of wells in Bombay High, has 250 people. So how to avoid that kind of a situation? Our assumption is post-retirement we will live. We're not assuming that we're going to just drop dead. Make a choice, 10%, 100% safety plus some risk and growth is what you need to sort of decide. If you're in good health, don't need this money at least for 5 years, and we'll leave money to someone. These are very, very important assumptions. Somebody asked me, in one of our sessions that I'm already 75, where should I invest? So I suddenly had this idea, because I knew him and I knew that he had a son, only child was a son. So while talking to him, I got this sudden idea. I said, who will you leave the money to? He said, of course to my son. I said, it doesn't matter, because you are thinking your age is 75 and you may have another 10 years, but the horizon for that money is not 10 years. It is that plus the age of your son, as long as he lives. So it really doesn't matter. If you want to leave it to someone, then you definitely can afford to think long term, because then you're giving that much more time for your money to sort of grow. So my suggestion is between 60 to 65, invest at least 40 to 50% in equity mutual funds. This is not something that too many people will tell you, but I am haunted by the fact of high inflation in this country, which is destroying wealth, and it's an eternal battle. 9% banks pay me, 12% I have to sort of pay. It's like a treadmill. I can't get off that. So the only opportunity that we have is not gold or chit funds or real estate or whatever. It is equity mutual funds, which is transparent. And I'll spend 2 seconds later, 2 minutes towards the end of the session to explain why I have faith in equity mutual funds. But at the moment, my suggestion is between 60 to 65. This is the kind of money that you need to invest in equity mutual funds. Above 75, if you have benefited from the above, and if you're leaving money to somebody, there's no need to change any of that. All right. So, two-part portfolio, one for the fixed income part, which is about 60%, use the income from this. Growth, which is the other 40%, use this to beat inflation. Withdraw if needed from the fixed income part at all. You should not, if you plan well in time, well ahead. Time your withdrawal from the growth part. This is a difficult proposition, and I'll explain a little bit on what I mean by timing of your withdrawal. To repeat, from good quality equity mutual funds, you should be expecting about 12% tax-free. Bank FD, it is 8.5% tax. This is a blended return that you're likely to get. If you want a slightly higher return, you may look at corporate fixed deposits. They're risky. They're totally unsecured. And if you sort of land up with the corporate FD of Yash Birla, you're never going to get money. It may be Birla, but it's gone. So that's a problem. You need to know where to actually invest. Corporate bonds, very interesting kind of an asset class, completely underrated. Instead of debt schemes, this is the product of choice if you are a little adventurous. Let me give you an example. Tata Power Bond or Tata Steel Bond, which was 11% coupon perpetual bond, which means it's like equity. It will remain forever. So if you want to take a little bit of risk, and I think you should, there's no harm in buying a Tata perpetual bond, which gives you an 11% coupon, and certainly better, 2 to 3% better than bank FD. So that is something that I would suggest, not necessarily corporate FD. I mentioned this point. The fixed income part of it, which is about 40%, I mentioned here right in the beginning. Create a two-part portfolio. Fixed income part is your 60% part. Growth part, which is equity mutual fund, is about 60%. That 60% you can divide as 70% in bank FDs, 15% in corporate FDs, and 15% in corporate bonds, or maybe 30% in corporate bonds. So one example I gave was Tata. The other example, let's say Cholamandalam listed bonds. Currently, it offers 11.12% yield. Tata Power yield is about 11.08%. All of these are solid companies, good companies that are not going to go bankrupt. They are also listed, which means that you buy it from the market, and if you need the money, or if you feel that this is not for you, or if you feel that it's risky, you're not locked in, you just call your broker and you can sell the bond. There's just no issues on that. They're highly liquid, all of these bonds. Between your savings account and liquid funds are slightly better on certain occasions, but there is, about 1 to 2% difference. If your savings account in banks is giving you about 4%, liquid funds will probably give you 5.5% or so. So there is about another 1.5% you can get on your fixed income part of your portfolio. All right. This is from an old slide. I'll just quickly go to the last point, which is the equity mutual funds. If you have saved in equity mutual funds, what is the time to exit? We have done a lot of research on this and a lot of calculation on this in terms of when the market gets overvalued, when is the time to get out before a crash of the 2008 kind happens, and so on. Our analysis took us to two particular funds, not to invest in these funds, but these two funds, which is FT India Dynamic P ratio fund of funds and Principal Smart Equity Fund. They use a particular formula to divide their assets in this manner. The P ratio applies to a P ratio of Sensex or Nifty. All right. When it's below 8, they put 90% of the money in equity component. Okay. When it goes above 28, that 90 has gone down to only 10%. Now, again, I'm not suggesting you should invest in these funds, but I have looked at this data, I've taken this formula and I've tested it. It works out fairly well. There will be one or two occasions in your, in 10 years, 12 years when the P goes below 8. It's a very rare occurrence. But when it happens, this is the kind of investment you would like to make, exposure you would like to have. By the way, where are we now? We are now between the band of 12 and to 16, when 60 to 80% of your money in that particular fund is exposed to equity. If you go back to what I said as an asset allocation, 60% is in growth and 40% is in equity. All right. So it comes to almost between 12 to 16 or 16 to 20, the middle band. If you were to come to me and say, hey, I have this corpus, what do I do now? I would probably, if I was using this chart, I would refer to this chart and say there's no reason to sell. To give you a practical application of how to be guided by this. As long as you follow this kind of a formula-driven approach, you would be fine. Now, somebody asked me whether to listen to an advisor. Once again, this is a formula that you can apply. No need to listen to somebody's gut feel or his idea or his concept of whether the market is going up or down. Don't be guided by the daily movement of up and down of the market. It means nothing. It's like pure noise. The signal is this, and this really plays out over a long period of time. Post-retirement support, absolutely key factor in all retirement calculations. All the things that I described earlier is only numbers, sterile numbers, nothing to do with what kind of support, and all of us have that support. I provide support to my parents and so do my friends and so on. So that will drastically change the calculations. Everybody has to do it in their individual cases. But if you feel that I don't have it or I don't want it, then of course all the things, calculations that I made, which is on a standalone basis, what you need to take into account would apply. Last section of the presentation, which is reverse mortgage. Not very relevant as of now, but it's going to be extremely relevant in 5 to 10 years from now, when a lot of people would eventually end up saving a lot of money through the property. There are two kinds of reverse mortgages, and this is how it works. You have a property. You contact a bank, the bank contacts an insurer. So essentially, the bank is passing on the premium amount of insurance from the insurance company back to you. What you're getting is an annuity. So the asset goes to the bank pledges it to the insurer gets the annuity figure back to you to be passed on to you. There are two kinds of reverse mortgages. One is where the property doesn't come back to you or to your legal heirs, or the second kind where the property actually goes back to you or your legal heirs. The amount that you get in the first situation is much more than the amount that you would get in the second. Okay, they are by and large more or less similar, but the figure that you would get in the first case where the property doesn't come back to you is much more. Just to give you an example, if the property value is around 50 lakhs or so, you will get 17,000 for the 17,900 for the first every month, and in the second case where the property comes back to the legal heir, you will get about 10,000 per month or so. This is reverse mortgage, not very popular today, but it's going to be popular someday because that would be the need of the hour at that time. Thank you very much for listening to me. I've taken a lot of